Welcome to this quite exposing and deeply educational video. My name is Louis, and today I will show you how to trade a simple model that will make you profitable. A simple model that will make you profitable. What you are doing, you are not doing much. What you are doing actually, what you are doing is just the basics, but you are doing it in a refined way. You are doing the basics in a refined way. Two things. The major concept you're trading is what we call demand and supply. We are trading price action based concepts. Okay, we're trading demand and supply. When price comes to a value demand zone, we buy. When price comes to a value supply zone, we sell. Basically, that is it. Now, but we're going to merge some things with demand and supply. Demand and supply works with some other concepts you need to understand. You need to know market structure, you need to know imbalance, you need to know momentum. All these things come together to make demand and supply a very solid concept to trade. So all of that, let's just call it demand and supply. And then we're going to merge it with our risk to reward model. We're just going to do 1:1 risk to reward model. So we are trading demand and supply on a 1:1 risk to reward model. And we are trading this on a what? On a static time frame. What do I mean by static time frame? I mean that you are not doing top-down analysis, you are not doing higher time frame narrative, you are not doing any of those things, which is where most people get to struggle. Top-down analysis, higher time frame narrative are very important. It gives you the storyline of that asset, where the asset, where price is coming from, where price is heading to. You need all of that. But do you know that even if you are not yet at that level where you can easily do higher time frame narrative, structure your what they call it, your storyline and all of that, you can still be getting good trades. That is why I brought in this one is to 1 hour. So even in a higher time frame bullish structure, and you see a setup, that a valid bearish setup in that bullish structure, it could be a pullback or whatever. This one is to 1 hour is likely to still give you your target and your take profit. So without taking much of our time, as an intraday trader, let's get right into it. I'm using the 15 minutes for this example. Anything lower than the 1 hour can work as this example. I'm not doing any higher time frame. Price is coming from here, price is heading here. I just want to show you how these things work. So I'm going to use the 15 minutes with the recent price action of volatility 75 to show you. Let's get to the 15 minutes. You could see how the 15 minutes is nothing to write home about. But when we open this market clearly now, we can start seeing some things in this market. Let's open this market clearly and see where we are in this market right now. Just with the most recent price action, we can see what we can get from this market. Let me see. So this is the most recent price action of volatility 75 on 15 minutes. Even though it seems to be like, oh, what is price doing? Price is ranging, price is ranging. Actually, in this whole thing, you can get one or two setups. You can get some forms of setup. All right. So the major things we are looking at, the first thing we are looking at is we're going to look at the significant structure break. So if we want to do that, our most significant break of structure is just somewhere around here. We took this high. Price took this high. You can see where price took that high, just somewhere around here. Price broke this high. And when price broke that high, what did it do? This momentum is gathered here did not break that high. This was the last significant high on this structure, this current price action. When price gathered this momentum and pushed upwards, you could see the impulse move away. It got to this high and failed to break. Just came close to it, dropped again, and then gathered more momentum and finally did what? Broke it. And this was the price action that broke momentum. So you're going to mark the last candle the last candle, the origin of where the momentum was broken. This is the main origin, primary origin. But the one that broke structure is the one you're going to prioritize. The one that broke structure is the one you're going to prioritize. The last candle before the impulse move away. So now we have our structure break. We have our structure break. We'll look at this. This couldn't take the structure high. This took all this structure but never did come back. So this main structure finally broke. You could see that price has a bullish momentum. It did some pullback here and then broke, created this small demand here. So we're going to mark that primary this demand here that actually took structure. So we're going to mark this demand here, the last candle before the impulse move away that broke structure. And the what validates a demand zone or a supply zone is that number one is going to break structure, is going to break structure. Number two, there must be some form of imbalance. Number three, it must be at the premium or the discount zone. So for what they call it, for demand zones must be on discount of the range. Supply zones must be on the premium of the range. So this is what validates a zone. The zone has to break structure. The zone must have some imbalance. And if it's a demand zone, it must be on the discount of the range. If it's a supply zone, it must be at the premium of the range. So when you have all this set together, it validates your zone. It validates your zone. And to maybe add some more to it, it can have liquidity. It must have liquidity, some form of liquidity. Liquidity. This liquidity could be, it could be what they call it. It could be an inducement liquidity. It could be a structural liquidity. It could be an engineered liquidity. Inducement, structural, and engineered. However, you need to learn all this. So it must have liquidity, and I think that is it. So if you have all of this together, if you have all of this together, if you see a zone that gives you these four things, the zone broke structure, it has some form of imbalance, and it's a demand zone that is on the discount of the range, and it has either of this liquidity, it is a valid zone. Right? It is a valid zone because that zone is likely to hold. There's a high probability that the zone will hold. So let's not take much of our time. Let's just go right into it. So this zone actually meets all of that. I'm just saying this to give you what it means to have a valid zone. Some people have some people don't know how to mark valid zones, and that is why they are missing out on trades. So from this low, because this is our range, not the full range now. This is the range that actually, because this is a valid high, this is now the range that actually took out this internal high and that external high. So this was the range. If you mark from this low, you mark from this low to this high, you can see that this price action actually met this range. This zone actually met all the criteria of a value zone. This zone was where we got enough momentum to break structure high. We broke this internal structure high and the external structure high. It has this massive imbalance, the space between this candle and this candle, candle one and candle three. This massive fair value gap, we have it. It is on the discount. Discount is anything below 0.5. It is at the discount. In fact, this one is at the extreme discount because this is extreme discount, this is premium, and this is extreme premium. That is why I divided my Fibonacci into four quarters. At the topmost quarter, we have the extreme premium. The next one is premium. At the bottom quarter, we have the discount. At the bottommost quarter, we have the extreme discount. So demand zones must be on discount below 0.5. So anything from here down is discount. and I prefer it when it's on extreme discount, which is what this zone did. It got deep into the extreme discount. So we have it. So, and it has liquidity, which of course I'm going to show you. What it did is that it broke, came back, engineered liquidity. This is an engineered liquidity. Remember, I said you must understand what is an inducement liquidity, a structural liquidity, and engineered liquidity. It came back, engineered liquidity, did as if it's buying, and then came fully to mitigate, clear that liquidity it engineered. Even engineered it again, came back, cleared it, but all within this inside the zone, and then finally bought. So that is the characteristics of a valid zone. Now you know what a valid zone is. Let's get right into it. We didn't do top down analysis for this, we didn't do much for this. We just want to see how we can be on one time frame and catch trades. Remember, I said if you are trading it on a static time frame without doing all of that, you need to trade a risk to reward model of 1:1. Of 1:1. The truth is, if you trade the risk to reward model of 1:1, after price has given you this engineered liquidity, you enter on the next step. So you put your entry here, 1:1. You bring your SL just below the zone. Your take profit level and your stop loss level, they have to be the same. So which gives us a 1:1, which gives us a what? A 1:1. So you have something like this, and this is a successful trade, profitable. You hit take profit. So you hit take profit trading 1:1. You hit it faster. You have this high, which was your drawn liquidity. Of course, price finally broke that high. After doing all of that, price came back, broke that high. Now, when price broke this high, where was the candle that had enough momentum to break that high, that had some imbalance? This is it. This last bullish candle was the candle that pushed to the upside that broke it. Okay, it started the move. So you're going to mark that bullish candle and just wait. I'm telling you, what I'm showing you is something that can transform your trading and change your account for life. All right. I did this out of intense study. I figured this out of intense study. Everything I'm showing you here is something that can change your life for good. All right. So we have this price broke this high and so and bought all the way to this high. I believe you understand this now. I'm going to remove it. Maybe one of these days I'll talk about liquidity, the three types of liquidity, and teach it in depthly so that you understand. But this is what validates a zone. But let me take it out. Now, when we broke this high, we created this. There was not enough pullback to mitigate this. So it just kept buying. And when it was buying, this price action here is fully efficient. If you look closely, you see that there's nothing like an imbalance here. It was fully efficient until it got here. But even this one did not break any structural high. There was no structural point it could break. The only imbalance was from here, but there was no structural point. It did not create this imbalance and come down before it broke. So still the valid imbalance we have, the valid zone we have is this one at the discount. So what did price do? Price came all the way down here, engineered another liquidity, did as if it's buying, came back, cleared that liquidity, actually mitigated us, gave us our 1:1. Gave us our 1:1. Another buy candle, another buy setup, valid buy setup. If you had entered, even if you, the good thing about this 1:1 trading model is even if you get in on the liquidity, maybe price did not have any valid liquidity, comes back to engineer liquidity, you can still cash some profits. Even 1:1 will still hold. Because if you use this zone as your liquidity, this zone would have held, it tapped into your zone, gave you take profit. But let's even assume this one did not hold. Let's use this. So you can see that your SL will just be below that candle there. Your TP is going to be 1:1. 1:1 is somewhere around here. If I can get it, yes, somewhere around here. And price did not take time to give you that take profit. Our second take profit. Now, in this whole range, in the series, of this, when price was coming down to mitigate this zone, it was creating a series of higher low, lower low, higher low, lower high, lower low, lower high, lower low, lower high, lower low, before it finally mitigated. So when it was doing all of that, all these things are not your problem, because the issue why people get stopped out a lot on trade is that when price was coming back to this zone, people will start trading all of these internal zones. All of these internal zones. If you are trading internal zone, trade it pro trend, not counter trend. Trade it pro trend, not counter trend. Now that we've been catching bullish trades, if you want to trade any form of internal structure, trade bullish internal structure. When it is selling, it might not give you a clean structure to sell from and all of that. Because now what we make this trade bearish is that this trade is going to have to do what? Clear this last low it created here on the bullish move. It has to clear this last low. Look at this last low. This last low is our low that if it had cleared, we'll start looking for sales. But it didn't clear it. It just came mitigated and kept buying. You understand? So that was our low of the range, and this is our high of the range on this 15 minutes trading time frame. This is our high of the range. That place I marked was the low of the range. So you can see something like this. So inside this range, we are waiting for price to take out either the high or the low to create external structure. And when it does that, we can start looking for valid demand and supply zones to trade. When when the range high is taken, all the demand zones becomes valid so that we can trade to the next range high. When the range low is taken, all the supply zones become valid so that we can trade to the next range low. But when price is trading inside of this range, inside of a range, it becomes internal structure. An internal structure, you don't trade it counter trend if you are going to trade it at all. If you don't trade it at all, you'll be good. If you don't trade it at all, you will be good. You just wait for price to take out the high of the range or the low of the range. Okay, when price takes out the high of the range, you look for value setup. When price takes out the low of the range, you look for value setup. So that way, you will have very high probability setups. So this one worked. This one took out the high of the range, created this new high, came back mitigated, and now we started the journey of taking this high. All right, all this sell structure. Some people want to reverse the market too early, and it did not work until markets mitigated a valid zone and took time to reverse. And it bought until it took that high. But the thing now about that high is that it didn't break structure above, it just swept structure, which means a rejection that signifies, oh, we might start selling. We might start selling. Did that rejection, did double rejection, and then came down to break an internal low. This was the last internal low that took that high. Okay, this was the last internal low when price was on this bullish move. Higher low, higher high, higher low, higher high, higher low, higher high. That's web structure. And then it did this without creating any meaningful structure. But finally, it broke this low. This was the last higher low. It broke it somewhere around here. So if you mark it that way, you'll see that this was the last internal low that swept that high without breaking it. So let's mark that low. If we mark that low somewhere around here, this is the low. If we mark that low somewhere around here, we can see that the low is something like this, and this was where price broke it with a candle body. Price broke that low with a candle body somewhere around here. So this becomes a break of structure internally. Internally, this becomes a break of structure. A reversal pattern when price breaks the last low. All right, the last low in a bullish trend, when price breaks it, is mostly a reversal pattern. Okay, and start creating lower lows instead of this was the last higher low or lower higher, either way you want to call it. Higher low, and now its price is creating lower lows. So when price broke it, there was nothing we could do. We start looking for bearish trade setup. We start looking for what? Bearish trade setup. Because price did not break this high with a body. If price has broken that high with a body, we would have looked for valid demand zones. And from here, what I could see, this zone was mitigated, this zone was mitigated, this zone was mitigated. The only unmitigated demand zone I'm seeing here would have been this one, just somewhere around here, this zone here. If this structure had closed above with a candle body significantly, this zone would have been our zone to enter and target that high. But it didn't do that, so this zone did not hold. You can see clearly that this zone did not hold. That's why you see that zones did not hold. I'm telling you why zones don't hold. Sometimes this zone did not hold, this zone failed because price did not close above with a candle body. Price swept it, liquidity sweep, rejected, cleared this zone, did all of this it did here, and then finally broke that low. And when it broke that low, what did it do? You start looking for sales. After breaking this low, what is the most valid supply zone here? All this place has efficient price action. Everything here is efficient. The most valid zone we have there is the last candle that has an imbalance before an impulse move, which is this bearish candle here. So you have this bearish candle here, you mark it, and what did market do? Market mitigated it and sold to break structure low again. It broke this low, which was the last structure. Broke it here. He broke it here, right? And when he broke it, he put in, when he broke it here, it came down. There was no form of inefficiency here. Market was fully efficient. All the price action here was efficient and all of that. It came down, created its own inefficiency that it will use. Market just reacted from this zone and sold. When he sold to this point, you look down all this place. Market inefficiency. This place is efficient. This place is efficient. The only inefficient price action there that has an imbalance is this place. If you are looking at it carefully, because this becomes our new range. This becomes our new range. Range high, range low. All right, range high, range low. What did market do? Market came back, mitigated it, and we are on that move to do what? To break this low. We are on that move to break this low. I did a video last night where I was talking about the other zones and all of that, but the audio for the video was not quite clear. I had to redo it. So, what is the win rate so far? On Tuesday, 6 p.m., we got a 1:1 trade. On Wednesday, we got a 1:1 trade. On Thursday, we got a 1:1 trade. Today is Friday. We are catching a 1:2. So every day you come to the market, look for your best setup. Just on that particular time frame, you are not even doing so much. You are not doing so much. You are not doing so much. Some people will say, "Oh, 1:1," but now you can see the profit margin on it. You have done 4 hours already. You have done 4 hours within a week. Do you know what is 4 hours? If you are risking a percent per trade, you are up 4% on your account. You are up 4% on your account. That is crazy money within a week. Even though price looked as if it was consolidating. Price looked as if it was consolidating. If you are trading 1:1 on this, you'll be up a lot of money. A lot of money. I was not trading 1:1 before. Someone called me and advised me. The thing about having a concrete bias is that you think what you know is alpha and omega, but what you know might not be working. Somebody gives a tweak to what you know. I've been trading demand and supply. Sometimes I get hit out before price gets to my zone and all of that. A friend of mine called me, senior friend of mine called me and said, Louis, just trade it like this. You have a good strategy, you have a good model you are trading. Trade this thing like this and save yourself the stress. If price is bullish, look for 1:1 setups using your trading model. If price is bearish, look for 1:1 setups using your trading model. So for the week now, starting from Tuesday, for the week, you are up 4 hour. You are up 4 hour. These trades, they all actually played out to more than 4 hour. This one played out to the drawn liquidity. I'm not saying that holding your trade to drawn liquidities are bad. This one played out to drawn liquidity. This one played out to the drawn liquidity, which is this high, which actually gave me about 5 point something R. This one played out to the drawn liquidity, which is this low. And this one also played out. It hasn't played out yet, but it will play out to the drawn liquidity. Okay. This is 1 is to 1.9, 1 is to 5, 1 is to 3, 1 is to 3. So 6 plus 5, 11 plus 2. We'll have about 13R on this. Okay. Which is not bad. Which is not bad if you hold all the trades. But if you don't want to bore yourself with all of that, you get in on your 1:1, you get out. 4R is still very, very solid for the week. Closing your accounts on 4R is still very solid for the week. Another thing you need to understand, for this to work for you, you need to trade minimal assets. Let's say 3 assets at most that you understand best. Volatility 75, which is an indices asset, derivative indices. You can pick 2 to 3 assets that you have studied to some extent, you understand it, and you just trade those assets. Now, these 4 trades all hit TP. Remember what I talked about trading internal structures. If we are trading bullish internal structures, look at what we would have done here. When price started buying, for here to get continuations, bullish continuations to get to this high. When price started buying, what would have done? What would have done is this. Price mitigated, broke this high internally. Let's mark the internal structure and see what would have happened. We'll break this high here with this candle body. And when we took that high with that candle body, we came back to this zone, which was our demand zone, valid demand. These are valid demand zone. What did price do? Price mitigated it, and boom, we got our TP. Continuation trades. We got our TP. Price mitigated it. We got our TP. So your stop level and your take profit level has to be the same. Just 1:1. You don't need to add any drama to this thing. 1:1. Now, the second setup, this high, we want to see price take this high, which actually happened. So you are not bending your rules, you're actually following everything about your rules. Price broke this place. Second continuation entry. When price broke this place, what happened? The demand zone failed. This was the demand zone here because this was the place that has inefficiency. Remember, I said you don't bend your rules so that it must work. No, you stay with this rule. Your system must be rule based. This is the demand zone. It failed. What it did was that it mitigated the other block, the last bearish candle before the buy. But I don't trade last bearish candle before the bullish move or last bullish candle before the bearish move. I trade last candle before an impulse move. The last candle that has inefficiency before an impulse move. And in this place, there's no inefficiency here. The last candle that has inefficiency before the impulse move was this candle before this break, this impulse move here. This one had enough impulse, but there's no inefficiency, there's no gap. This place mitigated it. It was mitigated for me. So this one was the one that did it with a gap, with that inefficiency, that imbalance I'm talking about, before it broke structure. So I'm going to trade it from this zone. And what it did is that it came down to that zone and blasted through it. Okay, it's a continuation trade. It blasted through it, but this place still held. It blasted through it, and because it blasted through it, you don't have a trade. When finally this high was taken, when finally this one reacted from the other block down here, the last sell candle before the buy and all of that. When finally this high was taken, this high here was taken. Let's see what price did. Price broke structure again, took that high. When finally price took that high, what happened was that price started coming down slowly. It came down. So let's mark our valid zone again. This was the zone. I'm not using the other block. I'm using the zone before an impulse move away that has imbalance. So I mark this my zone. Consider bullish candle was the last candle before this impulse. Okay, and it meets the requirement, all the requirements of a valid zone. I can see this one held. So let's mark it. This one held. You get in on it. 1:1. You look for your stop level points, copy it and paste it here. So you have another successful 1:1 here without doing too much. So you have this one here. Okay, and then price failed to break the high. So you're not going to mark this demand. This one is obvious that you will not trade it. Price did not break that high. So even in internal structure, we are still able to catch two trades out of three. We caught two and missed one. So we have plus 1R in it. Let's calculate our trade so far and see how it have been. This is 1R. This is 1R. We got a trade here. Got another trade here 2. Got this one 3. Got this one 4. Got this one 5. Got this one 6. And then lost this one, which is plus 5R. Plus 5R, which is not plus 5R is not something you take for granted. Having 5R in a week. So this requires that you understand structure very well. And I did all of this without doing top-down analysis. When price becomes bullish on that particular time frame, I trade bullish setups. When price becomes bearish on that particular time frame, I trade bearish setups. No complication, just staying on one time frame. I chose the 15 minutes because it is an intraday time frame. It gives clean structures for intraday traders. You can just trade this time frame and you'll be profitable. You can see what price action is doing here. Anytime you start pulling up or pulling or pushing down, pushing up or pulling down with so much impulse that it doesn't give any structure, you leave it and you wait. Whenever it stops, you can come back to trading it. And this happens across all assets. Now, when you mix this with trading your 1R, at the end of the week, you will be up something tangible. This 1R trading strategy, trading a risk to reward model gives you a very high win rate because price will never reverse against you. It will be so difficult for price to reverse against you. Price will reverse against you only in situations like this that is valid because you are trading internal. If you forget about trading these internal structures, your win rate will be very close to 100%. Okay, so trading demand and supply, even on a static time frame without having to do higher time frame analysis, what they call it, top down analysis, higher time frame narrative, and all of that, even without having to do it on just your intraday time frame, which is the 15 minutes time frame for your intraday trades. You get in and get out of a trade. Each trade doesn't cost you up to 2-3 hours. You're out. 2-3 hours. You're out. For example, we gotten on this trade around 1:30. By 2 p.m. we're out. We got in on this trade around 4:30. By 4:45 we're out. We got in on this trade around 1:15 a.m. By 1:30 we are out. We got in on this trade around 6:15 p.m. This one took some time. Even at that, by 7 p.m. we are out. Got in on this trade around 3 a.m. and this one was the longest. By 4:30 a.m. Not still not up to 2 hours. We were out. So you could see how efficient this model is. You can internalize this model. You have any questions, please do ask. You want clarity, please reach out to me. You want mentorship, coaching, you want to trade this, you want this to be your bread and butter. This is my bread and butter. You want this to be your bread and butter, to pass prop firms, to make crazy money. I did it. It looks so easy. You go back to try and do it. You are having serious issues doing it. It's fine. It takes time. This is a lot of concepts coming together. The 1:1 risk to reward model I added to it is part of it. It is part of it because remember, you are trading a static time frame. So you don't have an idea where price is coming from, where price is going. You are just on one time frame. And you can do this on any time frame without top-down analysis. For people that don't understand how to do top-down analysis, people that don't know how to. So if that has been your problem, you can pick one time frame as an intraday trader. Look for valid structure breaks. You must know market structure. Valid structure breaks, validate your zones, and trade in that zone. Trade in line with the current structure you are seeing in the market. If it reverses, if it changes, you change. You follow this. Now this zone, the time frame, the immediate time frame you are on, creates your own story for you. How we started, I did not do any time frame, any top down analysis. I didn't see much. I just came to one particular time frame, which is the 15 minutes, and I did all of this on 15 minutes. So you can do it. It is something that can be done. All right. It's something that can be done on any asset. Even though price is stuck in a range, you could see how we got 1, 2, 3, 4, 5, 6 trades, then lost one. So plus 5R, and we are done for the week. Just one trade a day, one trade a day, one trade a day, one trade a day, one trade a day. You just set price alerts for your zones. When your alert triggers, you know. Once a zone, look at how to trade it, please. So you don't have to be on your laptop 247. When a zone is broken, you can see that this zone has started selling again. I'm waiting for this zone to break. Once this zone breaks, I will set my entry and leave it. Once a zone breaks a level, a structure high, a structure low, that zone becomes valid. Is the first criteria to validate a zone. Okay. Once it breaks a structure high or a structure low, it becomes valid. So right now, this zone broke this high, came back, came back, mitigated, and we are selling because this was the highest. This was the lowest it went to. It came this demand zone now. We are not going to trade it, and I'll tell you why. We are not going to trade this, and I'll tell you why. If you know why, you can drop it in the comment section, but I will also say it. Why we're not going to trade this zone is that this zone pushed all the way down here. It could not break structure. It broke internal structures and all of that, but it could not break the structure low here, and it failed to break it. So now we are back, came back to gather some momentum, and we are pushing. If finally we break this structure, this would be my zone. And you don't do it before, you do it after. You just wait and wait and wait and wait. Trading is a waiting game. You have to wait. So this is where I will be trading from. If it gives me an efficient price action, maybe this impulse move I'm seeing now, it continues like this and then continues like this and then takes this low. If this impulse move holds and takes this low, this will be my zone to continue a sell. I will just take it on 1:1. All right. So that is how to trade it. You first of all you wait for your zones to break. And why I say minimize the number of assets you trade to maybe two or three at most. Some people trade one asset and that is all they need. Once there's no setup on that asset, they will leave it. They will wait and wait and wait and wait and wait till there will be a valid setup on that zone. Now you could imagine getting plus 5R in a week. One of the issues with trading is that people have unrealistic expectation. You want to make 50 hours, 100 hours, and all of that. You don't need all of that. People look for 4% a month. How much do banks pay? Your interest in the bank, what is it yielding? If you can do 5 hours in a month, you're a very solid trader consistently. You're a highly profitable trader. Do you know what is 5 hours? 5% of an account in a month. You are a very solid trader. You have a 100K account. You are doing $5,000 every month on that 100K account. Do you know what it means? Do you know what it means? You are doing serious numbers. In 4 months, you've done 20% of the account. In 4 months, you have done 20% of the account. In 10 months, do you know what you've done on that account? You've done 50% of the account. In a year, you've done over 60%. So, what else do you want? What else do you want? But people overestimate what they can do. If you do it this way and you are stuck with this trading model, just stay with this trading model that I've shown you. Stay with it. In a week, I assure you, at least 2 hours, you'll be 2% up on your account, even if you take losses. It is highly profitable, which is a model I have refined to this zone, to this point, and this is currently what I'm trading. In the future, I might still refine it. This is currently what I'm trading. So if you can just stay true to this, stay true to it, stay true to it, don't change, don't jump around, stay true to this. I'm going to do a boot camp that will break down demand and supply to the point where it will not be complicated for you. Okay, market structure and all of that. I'll break it down how to read market structure, internal structure, external structure, all of that. By God's grace, I'll find time to do all of that. So you will use it to study and then use it to trade. All right, use it to trade. This is extremely beginner friendly. So if you're a beginner, you don't know how to do top down analysis. Top down analysis, I'm not against top down analysis. In fact, I preach for top down analysis. Top down analysis is the best thing that can happen to you. But if you are in that phase where you don't really understand much, you can trade just a static time frame. A static. Okay, look at what price action was doing here. What was price action doing here? When price started buying, let's see if we'll catch anything. Price broke this last high, right? When price broke this last high here, broke it with this candle here, we know that, oh, price wants to start buying. When price did that, what did it do? You are going to look for, this was where it broke it. You are going to look for valid zones or mitigated zones. So you mark your zone. For now, I can't see any form of inefficiency. The only inefficiency I can see is this one. You mark your zone, and what did price do? Price ignored it. Price ignored it. Price ignored this thing, this whole thing it did here. Price ignored it. This place was not inefficient because here mitigated it before it bought. Price ignored it, blasted through, broke this high. Let's mark the second high it broke through. Price ignored that zone, blasted through it, broke this high. All right. And when price broke this high, still following your model. The good thing about this model is that when there is no trade, there is no trade. You are not forcing it. Still following your model. This is our zone at the extreme discount. This is our zone. What did price do? Price ignored it, blasted through, blasted through, and broke somewhere here. Broke structure somewhere here. There was so much bullish momentum. Price was not doing deeper pullbacks to mitigate our zone. And when price broke structure somewhere here, where was our zone? This place right here became our zone. You just follow price. What did price do? Price ignored it. Ignored it. This was the high. Blasted through the high. Blasted through the high. You can see that when it blasted through the high, where was our zone? This is our zone here. What did price do? Price ignored it. So all here there was no mitigation. Blasted through, this zone was ignored. Blasted through, this zone was ignored. Blasted through. I think the last one it did held a little bit. It blasted through this high, or the last high. Price was so much in a bullish momentum, there was no trade. If you trade this particular model I just showed you, the zone, value zone was here, and that was where we started cashing 1:1. So we cut our 1:1 here. All right, we cut our 1:1 here, but now we got on a bearish move again. Immediately we blasted through this zone, this zone, this zone, this zone, and this zone. We'll start selling. Here worked. So you could see that from here, from July, from 26th, last week, Sunday, there was practically no trade. Sunday, no trade. That same Sunday, no trade. Sunday, Sunday. Okay, this was Sunday. On Monday, there was no trade. Then this was Monday evening. Monday early morning, we cut this trade by 11. And then we got on that trade. Now, when we started breaking lows, when we started breaking lows, started breaking low somewhere around here. I want to show you that this model on a static time frame, if it doesn't come to your zone, you leave it. Opportunities will always come in the market. When it broke this low, this was the last low, blasted through, broke this high, and then it broke this low. When it started breaking lows, we'll start marking what? Supply zones. We'll mark our supply zone, mark our supply zone here. It did not come to it because it finally did come to it, and it gave us our 1:1. It finally did come to it. It gave us our 1:1 before we started this. That was why it did. That was one of the reasons this zone could not break above, because this supply zone was in control. Price had to respect this supply zone. You could see how powerful this thing is. And why I say trade 1:1 is that irrespective of price direction, irrespective of bias, if your zone is a valid zone, it will give you that 1:1. There's a likelihood that it will give you 1:1, and you get out of the trade. You don't need to prove anything to anybody. Your style of trading does not really matter to anyone. You just want to be profitable. Okay? So you can have your 1:1 and you're out of that trade because it mitigated. Actually, within the next candle, this one mitigated around 130. By 115, you're out on take profit 1:1. Before we are now fully bullish. We took that high and took this internal also. Before we became fully bullish, this was the last sell we had, even in this bullish trend, this obvious bullish trend. Let's look at this bearish trend right here. This one held finally. So this bullish held. This is very comprehensive. If this is the only thing you learn and you stick with it and you stay true to it, you're going to be profitable. I'm also talking to myself because I'm still on that journey. So let's see. Let's see. 1:1. The same candle that mitigated this zone also gave take profit. Have your 1:1. So we started selling. When we started selling, we broke through this low. We broke this low somewhere here. And when we broke this low somewhere here, we are going to look for what? Valid supplies. All here was mitigated. All here was mitigated. Where was your value supply? Your value supply is somewhere here. This zone, this place that has this inefficiency. Always use this zone that has inefficiency. You mark this one here. When you mark it, you take your 1:1. 1:1. You don't want to compromise on that. Believe me, you don't want to compromise on that. You take your what? Your 1:1. It's going to get you in and get you out of the market before anything happens in the market. You are out. You take your 1:1, which ended in take profit. You get in, you get out. Price mitigated you by 6:30, gave you profit by 6:15. Gave you profit by 6:15. So here you wait until price breaks structure. Price broke structure around here. Breaking structure with a candle body, not with a candle sweep. Break structure with a candle body, not with a wick. So here was what broke structure. Here did not break structure. All through here, there is no inefficiency. So we don't have any trade setup. There's no marketing efficiency. There's no zone that is inefficient. There's no trade setup. So you allow price do all of this thing it did by itself. There's no place to enter the trade here. There's no place to enter the trade here. This place was not on discount of it. It's not the discount of a range. This place here was not the discount of a range. It's too tight. All right, we are not making excuses for it. Okay, let's say we take the trade here. It's just too tight. That's what I'm saying. Just too tight. Take the trade here, you're going to end in a loss because this place mitigated and then it took you out. So the next zone we are going to mark is what? This high. We'll mark this high or this one. Anyone you want to mark. Mark this zone like this. Broke it somewhere here. And when you broke it, you look for inefficiency. Where's our inefficiencies? We have our inefficiency here. All these places are efficient. We have our inefficiency here. The zone that actually broke. We'll mark this one out. And this one failed because price became bullish when it took this high. Price became bullish immediately it took this high with that much momentum. All right, so we have zones that failed, we have zones that held, and all of that. It's not a system that you're not going to take losses or anything, but you will win so much more than you will lose. This was a bullish trade, this was a bearish trade. So you have this one win, one win, one win, three. You lost two. You are still plus 1R. Let's say you actually took this one. Where's that one? You actually took this one, you lost it. You took this one, you lost it. You took this one, you got it. You took this one, you got it. So in these three trades, one, two, three. Where's this one? Where's this one? Four, five. Is it five? One, two, three, four, five. In five trades, you won three, lost two. You are still on plus 1R, which is a positive return. Okay, you are still on plus 1% on this day, Monday, Tuesday. Then from Wednesday, price started giving you good price action, and you are up some serious numbers now. You are up some serious numbers now. So we are still waiting to see what will happen here. Price is currently buying. If this buy is going to stop somewhere around there without mitigating this zone, and then a sell pushes through this zone, we are going to enter here. All right, we are not compromising without any higher time frame bias, without any top down analysis. We are just trading the trend. Whatever we're seeing on the market, we are trading it. We don't even know where price is rejecting from, what is happening. We are just trading it. It looks like, oh, you don't know what you're doing, but simply doing this, you're going to win so much. That's why I said the confluence for this trading this pattern is you must trade it on 1 hour. You must trade it on 1 hour. Don't try to refine it to give you profit on drawn liquidity. Just take your 1:1 and get out of that trade. All right, take your 1:1 and get out of that trade. You are going to end the week profitably. You are going to end the month profitably. All right, you are going to end the month profitably. So it depends on the kind of person you are. You can trade it on 30 minutes, 15 minutes, 45 minutes, 1 hour, but don't trade it beyond 1 hour. This type of trading I'm showing you now, from 1 hour down, 1 hour all the way down to 5 minutes. Pick one time frame, catch the structure, trade in line with the structure. If price is trending, you're going to have a very good time. If price is consolidating, you are going to still have a very good time. Whatever price is doing, you're going to have a very good time. Learn how to mark your structure high, structure low, your range high, range low, external liquidity, internal liquidity. These are things you should know, different concepts you should know, because it all comes together. But from what I've shown you so far, you can see that yes, you are going to have missed entry, you are going to have losing trades, but at the end of the day, you are going to have a lot of winning trades. A lot of winning trades. We can go as far back as whenever. We can go as far back as whenever and mark this, and you will see that this is just how this thing works. We can go as far back as whenever. We'll start marking all of this, and you see that this is just how it works. All right. You are going to lose trade. You are going to miss trades, but above all, you are going to win trades. Okay. But if you are an experienced trader, you know how to do your top down analysis. You add top down analysis to this, your higher time frame narrative, you are going to be unstoppable. So you trade only in line with the higher time frame bias. So thank you for your time. I hope this whole video kind of made sense to you. I hope you took a lot, you learned a lot from this. God bless you and stay safe. My name remains Big Lou. You can always reach out for your questions, for clarifications, for things you don't understand, and I'll try my very best to respond to you and see how I can guide you. Do stay safe and remain blessed. Bye bye for now.